Three stocks to avoid in 2026. Stock 1, Palantir. Now, Palantir is a very popular stock and it has great innovation and great use case, but the numbers tell a different story. Currently, the stock trades at a PE ratio above 500, which means people are paying an extremely high price for a company growing at only about 20 to 30%. So this means people are willing to wait 500 years for the return on investment. It doesn't sound reasonable. Now, even though Palantir has strong margins and low debt, the valuation is still too high that it leaves no rooms for mistakes. And when we're this late into the real estate cycle, overpriced stocks like these ones are the first to collapse because the market stops rewarding hype. Palantir would need unreal levels of growth to justify the price, and that makes it one of the riskiest names in 2026. Stock 2, Tesla. Now, Tesla is another company that has great branding but slowing fundamentals. Revenue growth has been cooling down, margins have been getting thinner and thinner, and competition is everywhere now. China, Europe, and the US. The PE ratio also is way too high for how slow the business is growing. Net margin is around 5%, which falls far below my value cycle matrix for a strong and safe company. Late in the cycle, expensive companies with slowing growth tend to fall the fastest. And Tesla had already struggled in 2025, and 2026 could be even worse if the market tightens. Stock 3, Nvidia. Now, Nvidia is one of the best companies in the world with the whole AI revolution surrounding it. But even great companies become dangerous when the price gets too high. Nvidia now trades at a very rich valuation with a PE ratio far above what long-term value investors would consider safe or reasonable. It's got strong revenue growth, but not strong enough to support the price forever. We've seen this before in 1999 when amazing companies like Cisco fell 80% simply because they were overpriced. Nvidia is not a bad business, it's just too expensive at this stage in the cycle. And right now, we're near the end of the real estate cycle, the stage where the market looks strong on the surface, but the ground underneath is cracking. Overpriced stocks with weak margin of safety fall first. Even elite businesses drop when the reset hits. And that's why I'm keeping my market exposure very small and building cash. Because when the crash comes, I want to buy these companies at prices that actually make sense. Now, if you do want to learn how I use my value cycle framework to avoid traps like these ones and spot the best buying windows, join my newsletter, link in bio. And comment down below, which stocks do you think is most at risk in 2026?